You don't need to be rich, lucky, or a Wall Street expert to start investing in stocks. You only need a phone, a few dollars, and a little strategy. If you're tired of watching your money sit in a savings account doing nothing, this is your no-nonsense guide to starting your stock investing journey the smart way. Investing in stocks has created more millionaires than almost any other asset class in history. Over the past 50 years, the S&P 500, a benchmark index tracking America's top 500 companies, has returned an average of 7% to 10% per year, adjusted for inflation. That means if you simply invested and held a diversified basket of stocks, your money could double every 7 to 10 years. Stocks represent ownership in real businesses, and as those businesses grow, so does your investment. For long-term wealth, few tools are more powerful than the stock market. When you buy a stock, you're buying a small piece, or share, of a company. If that company performs well, its stock usually rises in value. You can make money in two ways: through capital gains, when your shares increase in price, and dividends, when companies share profits with investors. Stocks are traded on exchanges like the New York Stock Exchange and NASDAQ, and their prices change based on supply, demand, news, earnings, and investor emotion. But beneath the noise, investing in stocks means backing real companies that create products, generate revenue, and grow over time. Before diving into stock investing, it's important to lay a strong foundation. First, make sure you have an emergency fund, typically 3 to 6 months' worth of living expenses, saved in a high-yield savings account. This protects you from having to sell investments in a crisis. Second, clear out any high-interest debt, like credit card balances, which grow faster than most investments. And third, decide your financial goal. Are you investing for retirement, a future home, or building general wealth? These steps aren't just checklist items. They're what give you the mental clarity and financial stability to invest with confidence rather than fear. To invest in stocks, you'll need a brokerage account, a platform that lets you buy, sell, and manage investments. Some popular beginner-friendly options include Fidelity, Charles Schwab, Robinhood, SoFi, and Webull. Look for one with no minimum balance, zero trading fees, and a simple interface. Once you open the account, connect your bank, transfer funds, and you're ready to go. Some brokerages also offer fractional shares, so you can invest in companies like Amazon or Google with just a few dollars. The good news is, you can start investing with as little as $5 to $50, thanks to fractional investing. You don't need to buy full shares anymore. What matters most isn't how much you start with. It's how consistently you invest over time. Even small amounts can grow into large sums with compound interest. The key is to start now, invest regularly, and stay invested for the long term. All investing involves risk, but not all risk is bad. Stocks are considered higher risk because their prices can swing up or down quickly. But historically, they've also offered higher long-term returns than bonds, savings accounts, or real estate. The trick is knowing your risk tolerance, how much fluctuation you can handle without panicking. Younger investors can usually afford to take more risk since they have more time to recover. As you near your goal, like retirement, shifting into safer assets makes more sense. As a beginner, one of the biggest decisions you'll make is whether to buy individual stocks or invest in index funds. Individual stocks are shares of specific companies like Apple, Google, or Tesla. While they offer the potential for high returns, they also carry more risk, since you're betting on one company's success. On the other hand, index funds, or ETFs, bundle many stocks into one package, like the S&P 500 ETF, which holds 500 top U.S. companies. This gives you instant diversification and lowers your risk. For beginners, index funds are often the better choice because they're simple, proven, and cost-effective. You're not trying to pick winners, you're investing in the whole market. Trying to time the market, buying low and selling high, rarely works. Instead, use dollar-cost averaging. Invest a fixed amount regularly, like $50 every 2 weeks, no matter what the market is doing. This smooths out your cost over time and takes the emotion out of investing. It's simple, automated, and one of the most effective strategies for beginners. Set it and forget it. Consistency beats perfection. Some companies pay dividends, which are regular payments to shareholders. These can provide passive income even when stock prices stay flat. Dividends are usually paid quarterly and can be reinvested to buy more shares. This is called a DRIP, Dividend Reinvestment Plan. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are famous for paying steady dividends. While not guaranteed, dividends can help you grow your portfolio faster, especially over time. One of the most common questions from beginners is, when should I buy or sell? The truth is, timing the market is nearly impossible, even for professionals. The best strategy is to start investing as early as possible and to do it consistently. Buy stocks or index funds when you have money to invest, and hold them for the long term. You should only consider selling when you've reached a goal, need the funds for something important, or the investment no longer fits your plan. Selling based on fear, rumors, or sudden dips usually leads to regret. Patience and discipline are what turn small investments into long-term wealth. When starting, you don't need dozens of stocks to be a smart investor. Simplicity wins. A beginner portfolio might include 1 or 2 broad market index funds like an S&P 500 ETF, VOOSPY, and a total market ETF, VTI. These give you exposure to hundreds or even thousands of companies in one investment. If you want to add individual stocks, limit them to a small portion, say 10 to 20% of your portfolio, and choose businesses you understand and believe in for the long term. Your portfolio should reflect your risk tolerance, your goals, and your time horizon. And don't forget, balance and diversification reduce risk and increase peace of mind. New investors often fall into common traps. One of the biggest? Chasing hype. Just because a stock is trending on social media doesn't mean it's a good investment. Others invest without doing research, or they go all in on a single company. Some panic during market dips and sell at a loss, locking in what could have been a temporary setback. Another common mistake is ignoring fees, which can eat away at returns over time. The solution? Stick to your plan, stay consistent, and focus on the long game. Most mistakes come from emotion, not logic, so stay grounded. The stock market rewards those who think in decades, not days. Building wealth through investing takes time and discipline. You won't get rich overnight, but that's not the goal. The goal is to grow your wealth steadily, let your investments compound, and avoid emotional decisions. That means not checking your portfolio every day, not reacting to the news, and not trying to outsmart the market. Some of the best investors succeed by doing less, not more. Just like a tree doesn't grow faster if you dig it up and check the roots daily, neither will your money. There are plenty of free tools and platforms that can make your journey easier. Use Yahoo Finance, Google Finance, or Morningstar to research companies and funds. Use apps like M1 Finance, Fidelity, or Robinhood for low-cost investing. Platforms like Seeking Alpha, The Motley Fool, or Investopedia offer great beginner education. Want to stay consistent? Automate your investments and set up recurring deposits. You don't have to do it all yourself, but you do need to stay engaged and keep learning. In the world of investing, knowledge is power. Yes, not because the market is up or down, but because your future starts today. Waiting for the perfect time is a trap that keeps people stuck. The best investors know there's no perfect moment to begin, only the decision to begin. Whether you're 18 or 48, whether you have $50 or $5,000, the most important step you can take is to start investing consistently. With every dollar you invest, you're buying more than a share. You're buying your freedom, your security, and your future potential. Start small, start smart, but just start. Stocks aren't just for the wealthy, they're for the wise. If you're serious about building wealth, gaining freedom, and taking control of your financial future, Stock investing is one of the best tools at your fingertips. So subscribe for more real-world investing advice, drop a comment with your first investment question, and remember,